Your credit card company has a name for you. Not your actual name. They call you a revolver. A revolver is someone who carries a credit card balance from month to month, never fully pays it off, just pays the minimum and rolls the balance forward. And internally, at every major bank, revolvers are the most valuable customers they have. Not because you're a good customer, because you're a profitable one. The average American revolver pays approximately $1,200 per year in interest, per card, on a balance they've been carrying for years, sometimes decades. That's not an accident. The system that keeps you in debt was not built by accident. It was engineered, tested, and refined over decades by some of the smartest people in the world, whose entire job is to make sure you stay exactly where you are. In this video, I'm going to show you exactly how it works, the psychological mechanisms banks use to keep you in debt, the specific product design decisions that are not mistakes, they're features. And the moment you understand this system, you can step outside it. Not by being smarter than the bank, by understanding what game they're playing.
Let's start with the most expensive invention in the history of consumer finance, the minimum payment. Before 1987, minimum payments on credit cards were 5% of the outstanding balance. You had to pay 5% every month. Balances went down. Cards got paid off. In the late 1980s and 1990s, banks began quietly lowering the minimum payment requirement from 5% to 4%, then 3%, then 2%. Today, the industry standard minimum payment is 1% to 2% of your balance plus interest charges, which means on a $5,000 balance, your minimum payment is approximately $100. And of that $100, roughly $83 is pure interest. You pay $100, $17 reduces what you owe. $83 is the bank's revenue. What happens if you pay only minimums on $5,000 at 22% interest? Time to pay off, 23 years and 4 months. Total interest paid, $7,723. Total paid to the bank, $12,723, and on $5,000 borrowed. The bank didn't hide this. It's disclosed in your cardholder agreement in 8-point font across 47 pages. When banks lowered minimum payments, they didn't do it to help customers afford their bills. They did it because a lower minimum payment means a longer payoff timeline. A longer payoff timeline means more months of interest. More months of interest means more revenue. The minimum payment was redesigned to maximize the amount of time you spend in debt. And here's the cruelest part. The minimum payment feels responsible. You're paying your bill. You're not missing payments. Your credit score stays intact. Everything feels fine, while $83 out of every $100 you pay disappears into bank revenue. In 1978, the Supreme Court ruled in Marquette National Bank versus First of Omaha that banks could charge the interest rate of the state where they were headquartered, not the state where the customer lived. Within 2 years, Delaware and South Dakota eliminated their interest rate caps entirely to attract bank headquarters. Citibank moved its credit card operations to South Dakota in 1981. Other banks followed. Within a decade, interest rate caps on credit cards effectively ceased to exist in America. Before that ruling, credit card interest rates were legally capped in most states at 12% to 18%. After it, rates began climbing. Today, the average credit card APR in the United States is 24.37%, 24%. To put that in context, the rate at which banks borrow money from the Federal Reserve, the federal funds rate, has averaged approximately 2 to 5% over the past decade. Banks borrow money at 2 to 5% and lend it to you at 24%. That spread, or the difference between what they pay for money and what they charge you for it, is not incidental to the credit card business. It is the credit card business, and the higher your balance and the longer you carry it, the more of that spread the bank captures. This is not a moral judgment. Banks are businesses. They exist to generate profit for shareholders. But understanding their incentive structure is essential, because their incentive is directly opposite to yours. The interest rate is the mechanism, the psychology is the trap. In 2001, researchers Dreisen Prelek and Duncan Semester at MIT conducted an experiment. They auctioned tickets to sold-out sporting events. Half the participants were told they had to pay cash. Half were told they could pay by credit card. The credit card group bid, on average, twice as much for the same tickets. Twice, for identical tickets, simply because they were paying with plastic instead of paper. Prelek and Semester called this the pain of paying. Physical cash activates a measurable negative emotional response in the brain, the same region associated with physical pain. Swiping a card produces no such response. Credit cards were not designed with this research in mind, but the industry certainly noticed it. and every design decision in modern credit card products amplifies this effect. The card is smooth and premium. Physical quality triggers feelings of status. Tap to pay reduces the transaction to a gesture. No PIN, no signature, no moment of conscious decision. Rewards points convert spending into a game. You're not spending money, you're earning points. Monthly statements aggregate hundreds of transactions into one number, making individual spending decisions psychologically invisible. Online shopping autofills the card. You never even see the number being charged. Every one of these features reduces the psychological friction of spending. Every reduction in friction increases spending. Higher spending means higher balances. Higher balances mean more interest revenue. The card in your wallet was designed by behavioral scientists and product designers whose job, explicitly, was to make spending feel effortless. Let's talk about rewards, because rewards are the most brilliantly designed component of the entire system. The average cashback credit card offers 1.5% to 2% back on purchases. Sounds great. For every $100 you spend, you get $1.50 to $2 back. Here's what you're trading for that $2. Research from the Federal Reserve Bank of Boston found that households with rewards credit cards spend, on average, 68% more per month than households using cash or debit, 68% more. If you normally spend $1,000 per month, a rewards card is associated with spending $1,680 per month. At 1.5% cashback, you earn $25.20 per month in rewards on $680 in additional spending. And that's assuming you pay the balance in full every month. If you carry any balance, the 24% interest rate on that additional spending produces far more bank revenue than the 1.5% cashback costs them. The rewards program is not a gift from the bank. It is a customer acquisition and retention tool, designed to make you prefer a card that generates more revenue for the bank. The reward is real, the cost is real, and the cost is larger. The credit score deserves its own conversation because it's the mechanism that keeps you voluntarily engaged with the debt system even when you want to leave. Your FICO score is calculated by, among other things, your credit utilization, your length of credit history, and your credit mix. All three of these factors reward continued engagement with debt products. Credit utilization, you need to use credit to have a utilization ratio. Zero usage eventually hurts your score. Length of credit history, closing old accounts hurts your score. You're incentivized to keep accounts open and active. Credit mix, having both revolving and installment debt improves your score. The system rewards carrying multiple types of debt simultaneously. The credit score system was created by FICO, a private company, and adopted by lenders because it predicts default risk. That is its stated purpose. But its practical effect is to create a number that people optimize for. And optimizing for this number requires remaining an active participant in the debt ecosystem. A person who pays off all debt, closes all cards, and uses only cash will see their credit score decline or disappear entirely, even if they have $200,000 in savings and zero financial stress. The score does not measure financial health. It measures engagement with financial products. This is why people with excellent financial situations still obsess over their credit score. The system trained them to. A high score feels like success, even when the behaviors required to maintain it involve ongoing debt engagement. Here's the final mechanism, and it's the one that operates completely independently of banks. In 2024, Pimps and Lending Club surveyed American consumers. They found that 62% of Americans live paycheck to paycheck. Then they broke it down by income. Earning under $50,000, 78% alive paycheck to paycheck. Earning $50,000 to $100,000, 65% live paycheck to paycheck. Earning over $100,000, 45% live paycheck to paycheck. Almost half of people earning over $100,000 per year, living paycheck to paycheck. This is lifestyle inflation. As income increases, expenses expand to match. New salary means new apartment, new car, new restaurants, upgraded phone. The raise is absorbed within months. The financial margin stays near zero. And with a higher income, access to credit also increases. Larger credit limits, more cards, larger car loans, larger mortgage. The debt trap scales with income. A person earning $150,000 can be just as trapped as a person earning $35,000, just with larger numbers and a better credit score. The exit from the trap is not a higher income. It is a different relationship with money, where income and spending are deliberately managed rather than allowed to find their own equilibrium. Now, the part that actually matters. Understanding the trap is step 1. Exiting it is step 2. And the exit is not complicated, but it requires doing things that feel counterintuitive because your entire financial environment has been designed to push you in the opposite direction. Write down every debt you have, balance, interest rate, minimum payment, every single one, on one piece of paper. Most people in debt have never done this. They know the debt exists, but they've never looked at the complete picture simultaneously. The psychological avoidance of the full number is itself part of the trap. You can't exit something you won't look at. The minimum payment is designed to keep you in debt as long as possible. Any dollar above the minimum is progress. Even $50 extra per month on a $5,000 balance cuts years off the payoff timeline and saves thousands in interest. The math is not close. The gap between minimum only and any extra payment is enormous. Before every credit card purchase, ask one question. If I carry this balance for 1 year, what will this item actually cost? A $400 purchase on a 24% card that you carry for 1 year costs $496. A $1,200 TV costs $1,488. The real price of everything bought on credit is higher than the sticker price, and most people never calculate it. 70% of people who call their credit card company and ask for a lower interest rate get one. The call takes 10 minutes. On a $5,000 balance, a 5% rate reduction saves approximately $250 per year in interest. Most people never call. They assume the rate is fixed. It's not. Unassigned money disappears. This is not a discipline problem. It's a system problem. The human brain is not capable of making 200 optimal spending decisions per month. A zero-based budget, where every dollar is assigned before the month starts, removes the thousands of small decisions that add up to financial chaos. One decision at the start of the month, then follow the plan. Banks are not evil. They are businesses operating within legal frameworks to maximize profit. Understanding their incentive structure is not about anger, it's about clarity. The minimum payment is not a payment plan. It's a revenue maximization tool. The rewards program is not a gift, it's a spending amplifier. The credit score is not a measure of financial health, it's a measure of debt engagement. And lifestyle inflation is not inevitable. It's a default that can be interrupted. None of this requires unusual discipline or exceptional income. It requires understanding the system well enough to stop participating in the parts that work against you. The trap only works on people who don't know it's a trap. Now you know. Every video on this channel covers one specific piece of the exit. From debt payoff methods to credit scores to budgeting systems, all of it is in the playlist below. The first step is the debt list. Write it down today. Not tomorrow. Today. See you in the next one.